if we got bad news about inflation going higher, the risk or the likeliness that the Fed was going to raise rates, that would cause the markets to go down and vice versa. But the interesting thing is, sometimes you get a jobs report, which is what I was thinking about. If you get a jobs report, that the jobs report was really good, you would think that that would cause the markets to go up. This is good news, right? But the market doesn't interpret that. The market interprets that as inflationary. So a good jobs report increases the chance of a rate hike because they want to try to bring it down. So anyway, thanks Taterhead for clearing me up here. But we found that the rate of inflation was starting to cool a little bit. Inflation narrative cooled off. It was still there, but it cooled off a little bit. But while all of this is happening, the reason why that inflation didn't get so out of control and, eventually turn into recession is because you had an AI bubble that was keeping the stock market afloat. If it had not been for this AI bubble, we would have had a market crash. Investors knew that, which is why they artificially, no pun intended, why they artificially created this bubble. They started buying out of the money calls like crazy on Nvidia, Microsoft, and Google, and Meta. Anyone that had anything to do with AI, they were buying out of the money calls, artificially jacking up the valuations of these companies, not for good reasons, bad reasons, not for any other reasons other than greed. And that forced the market maker to buy. Artificial investing, exactly. And so the AI bubble kept us from crashing. What happens when you get high inflation? Typically what happens when you get that is it erodes the purchasing power, right? So purchase power typically goes down because you can't get as much for your dollar any longer. So what ends up happening is consumers start spending less, right? And that's bad for business.